There's obviously been a lot of discussion over the last year about trade policy. How does it affect our thinking about monetary policy?
So first, I have to start by saying we don't have responsibility for trade policy. That's outside of our lane. But it does. Trade, of course, is a really important factor for the economy. And I would be of the view, and I think many of my colleagues are of the view, that over a long period of time, our economy has benefited significantly from trade. Trade drives productivity. It lets businesses sell their products, and people buy products from all over the world. So it's a positive thing. But we also know that trade needs to be both free and fair. So I guess I would just say that if this process that's going on right now winds up with lower tariffs and better observance of agreed trade rules, then that would be good for our economy and good for the world economy. If instead, perhaps inadvertently, it winds up in a place where we have more widespread protectionism around the world, that will be bad for our economy. And that would be unfortunate. In terms of what you really asked about is the near-term effects, and we don't see much. Of course, we hear a lot from businesses about higher costs, about loss of markets. We see a rising chorus of concern, largely through business contacts, through the reserve banks, but also our own contacts. It hasn't shown up yet in the data. Of course, it would be hard to see it in the data because you don't know what the data would have been without the trade issues. But in theory, you could see a little slower growth. If to the extent that more and more products are subject to tariffs, you could see a little bit higher inflation and a little bit lower growth.